Chapter 1. Investing in fast growers involves knowing when to run for the hills. A fast grower is a small company that experiences an aggressive growth spike during its startup stage, sometimes at a rate as high as 25%. It sounds like the best option if you want to shore up your portfolio and make it stronger. If you want to start your portfolio on a high note, invest in fast-growing companies. But with the rapid rise in profits, these fast growers come with the need for caution on the side of investors. You must first investigate if the increase rate has been steady and if their frontline product is a pivotal part of the business and not just a poster to distract from the other poorly performing stocks. Then you must ascertain that the success it experiences isn't a one-time thing and if the company has enough room to expand and grow. When investing in the very lucrative fast grower, verify if the company's price-to-earnings ratio, PE, is close or equal to its growth ratio. This analysis is known as the PEG method. When investing in these fast growers, make sure the growth isn't fabricated. Investors are advised to invest in fast growers, but not to put all their cash there to avoid an unfortunate outcome. The thing with fast growers is that even though they start off with a high rate of growth, it can suddenly, without notice, dip, and all your investments would be worthless. The trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. Stand by your stocks as long as the fundamental story of the company hasn't changed. Peter Lynch. Chapter 2. Slow-growing companies may actually be a safer bet for you. The allure of fast growers might not attract all investors. Owing to the known risks and the high-paced style of trading, it forces investors to adapt. Buy fast, sell fast. For these cautious investors, the safe option will be a slow grower. Slow growers are a safer option to fast growers if you wish to take less risks in the market. A slow grower is a company that usually pays dividends, and the dividends increase in value year by year. There are big money, established firms that are at a financial level where they will rise only slightly faster than the overall state of the economy. The precautions to be adhered to when investing in slow growers is to keep track of the company and ensure the dividends are being paid as regularly as they are routinely raised. If the dividends are being paid, then investors must confirm the percentage of dividends being paid. It has to be commensurate to the investment put in. The benefit of investing in a slow grower is that you are assured of dividends on your investment. The percentage is going to be an indication of what the company prepares investors for when they fall on hard times. A low percentage means that the company has set aside a fair amount to cushion whatever losses they incur that fiscal year. If the percentage is high, then the dividend, however high it might be, will be too much of a risk. Did you know? Peter Lynch used to work for one of the most prestigious and most actively managed mutual funds in the U.S., where he helped them to a record-setting growth percentage from 1977 to 1990. Chapter 3. Not too fast, not too slow. Stalwarts offer investors calmness for a change. The slow grower companies offer a slow and safe alternative to the fast growers, but for investors who seek a little more security, they should consider investing in stalwarts. Stalwarts are big, established companies that have little chance of going out of business anytime soon. They are the middle ground between fast growers and slow growers. They once had a high rate of growth, and now they are on their way to becoming a slow grower, but not yet. A stalwart is a sure banker that gives investors a safer route to a profit on their investment. This means that they aren't growing as fast growers and aren't growing as slowly as a slow grower. They are the kind of companies that are safe even during an economic crisis, even recession. The benefit of investing with a stalwart is that you can gauge their progress by checking the price of their shares and the price-to-earnings ratio. This way, you can know if you are paying too much for a risky venture. The company's long-term growth rate will also be indicative of what to expect from them in the coming years. A stalwart offers investors the promise of a long-term success plan, backed up with a history of success. The key quality of a stalwart is that it is dynamic and can hold its own during crises. They are, although, not very agile in the market owing to their assured standings. Chapter 4. The most profitable shares often come with a lot of ups and downs. Moving on from the slow-moving traffic that comes with safe investing, there might be more profitable options if you are bold enough to take a chance on them. These are known as cyclical companies. They are called cyclical because their profit frequency moves up and down in cycles. These companies boast a huge profit margin and returns for investors and stakeholders alike. They include firms like those in the oil industry or military equipment services. Companies like this are heavily dependent on the frequency of demand and supply. Companies that offer investors high returns often come with high risks of loss as well. Say, for example, there's a global pandemic. The dependency on oil will drop drastically, and as such, the companies that trade in oil will suffer great losses that year. But these companies once experienced a very huge return year in, year out. Investors in these companies will be wise to avoid using these companies as saving ventures. If they put considerable amounts into these companies, then they should endeavor to take their gains and run for the hills. They can also use the roller coaster theme of the companies to buy shares when they drop in value and buy into a potential rise. Investors should take note of the market behavior and buy when the stocks are low to profit when the value increases. If you were to buy when the price drops, then when it spikes rapidly, you would be able to sell off for a bigger profit. Chapter 5. There are investments that start out terrible, make a drastic and positive turnaround. In the business of share investing, there is little room for hope and faith in a neglected option. It is obviously a bad decision to invest in a venture you know will be a loss, and every expert will advise you to put your money where it's safest instead, in your pocket. But if there is an off chance that these firms that have been written off can actually become profitable endeavors, just as there is a dark horse in pop culture to mean a person or company that has little about it as public knowledge, but makes an unexpectedly good showing. The most unexpected stocks can turn out to be the most profitable if you take the risk. These companies are known as turnarounds. These are those investment opportunities that seemed like they are in a bad place financially, but are somehow able to turn their situation around, usually after a major financial crisis or upheaval within the ranks. Turnarounds are somewhat like cyclical companies, such that their share values are seemingly worthless, but they suddenly become very lucrative. Turnarounds are also similar to stalwarts because they can be companies that have enough repute and financial strength to turn around a bad phase. A turnaround company stays in business for its sheer capability to pull the right amount of finance to do so. For investors, it would be important to take note of such companies as they possess great potential for a higher return than other companies. An example of a turnaround is Apple Inc. Chapter 6. A wise investor is one that looks out for the dark horse in the market and sticks to it. Although turnarounds are a very smart yet risky channel to get one up on the market, they can be detrimental failures. You can invest in your chosen potential turnaround company and they end up failing to return to their former glories, and you'd be the one to suffer for it. It can be profitable to invest in wildcards in the stock market, but sometimes it can be a big fail. There are companies that only a few people know about them or their potential worth in the market. They are the real dark horses. They are unlike the turnarounds, but also alike. They have a valuable resource and will have a huge impact on the market. There are hidden gems that pay off massively in the long run, and only a few people get to know about them. These are known as asset plays. An asset play is to refer to its hidden asset that the company possesses. Investors who have knowledge of these companies will be at a huge advantage when the company finally reveals their product or service, bringing a huge reward for their investments. An asset play can be a subdivision of an established stalwart that has been earmarked to revamp the firm. An asset play is like a trump card to add to your portfolio to use to save yourself in the event that your other investments fail to come through for you in the fiscal year. A very good example of an asset play is Marvel Co., that is owned by Disney but was heavily downplayed. Now Marvel is a financial powerhouse, raking in a ton of profit year in, year out in the box office and in other related avenues. An asset play is a valuable addition to your portfolio in the event that all else fails. Those who had inside info about it and made an investment will be thanking their lucky stars. Conclusion. As an intending investor or even an existing investor, it is important to understand the nature of the company you hold and ensure you have enough valid reasons to keep the stocks in your portfolio. As explained in the short summary, stocks are in categories same as the companies giving said stocks. This categorization will help investors understand and know what to expect from them. Lynch has taught readers that the seemingly big companies bring the smallest return but the safest, whilst the small companies bring the biggest return but with a higher risk. As an investor, therefore, you must do your own research and look out for the companies that are firstly profitable and have been so for a long period. Then you check to make sure these profits are fictitious, as certain companies falsify profit just to attract investors. As much as it is profitable to invest in long shots, as revealed in Chapter 6, it can also be a pitfall for your portfolio. If you are to invest in any firm, you aren't fully abreast of their workings. You can trust the advice of experts in the field. If you must invest in dark horses at all, you must do so with little of your income to avoid placing all your eggs in one basket. A turnaround company presents investors with a huge return for little of their money. Lastly, a proper investment should be in a company whose earnings growth should be consistent and not topsy-turvy. Try this. Learn the tricks of the market and listen to the experts when they give tips from their wealth of knowledge.